We are also following oil because it's trading near a 2-week high, and our next guest says the trend is here to stay. Adam Sieminski is with us now. He is the chief energy economist at Deutsche Bank. Adam, always glad to speak with you. You say fundamentals are improving. Could we see $100 per barrel oil in the next 6 months?
Well, Deirdre, it's possible that oil could get that high, but I don't really think it's going to get there in the next 6 months. Maybe when we get out towards 2014 or 2015. Why it won't get there in the next 6 months? Oil has been driven mainly over the last year by improvements in the stock market and weakness in the dollar. And to get to $100, we'd have to have the S&P 500 at 1,400 and the dollar-euro rate at over 160, and I don't think that's going to happen in the next 6 months.
So, Adam, you mentioned there the weakness in the dollar, stronger stocks certainly influencing demand at least for futures right now. Where does weather fit in? We know we're coming up on winter here, and where does this European bailout fit in? I mean, that obviously affects the dollar.
Well, weather is probably more important for natural gas here in the United States than it is for oil globally. Northern Hemisphere oil demand is influenced by how cold it gets, but a lot of the growth that we've seen over the last a year or so has been coming from Asia, and parts of Asia are fairly warm, so I'm not sure that the weather is going to do that much for oil. You know, what has really been driving commodities in general is emerging market growth, so lots of GDP activity in the emerging markets, the improvements in the economy in general, the sovereign debt crisis and monetary tightening in China have tended to be disruptive factors. And right now, I think we're more in that disruptive mode than we are in the growth mode.
Adam, not all commodities are rising and falling at the same pace, but if you look at the trading patterns over the last several weeks, even months, they do look kind of similar. They peaked and then they fell off again. Which commodities do you think are going to start to break out and really trade on either their own fundamentals or perhaps some other factors that might be at work?
Right. Well, when you think about who benefits as the economies grow globally, stock markets improve, that is definitely going to help commodities in general. If we run into short-term problems with monetary issues in China and the sovereign debt crisis in Europe, that's probably going to be most dangerous for industrial metals and for the energy sector. Probably the safest place to be when you think about all of this right now is in the precious metals like gold and silver.
Now, speaking of gold, I think your forecast for gold is $1,600. How quickly do you think gold might hit that number? And given the deterioration that we continue to see in Europe, the pressure on Portugal, the pressure on Spain, and talk of the crisis going even further than that, could gold perhaps enjoy a faster run?
Well, we could see that happening over the course of the next year. It's possible that gold could even get up as high as $2,000 an ounce. That's what our research shows is the danger point when a bubble really looks possible. If you come back to some of the other areas that look attractive in the near term, agricultural commodities like soybeans and corn, inventories are relatively low and demand has been improving as diets change in places like China and elsewhere around the world, and that's going to be a big plus for those commodities.
What kind of price difference, Adam, could we see? You just mentioned this demand from China for some of these agricultural products. Can you quantify what you expect to happen in the next year in any way?
Well, this is basically kind of on a slow burn. As incomes improve in China, diets are changing, and this is a trend that's been going on for some time. Deirdre, this kind of fits into the same view that we have of oil. We think that oil will just continue to get stronger as the fundamentals improve, that things really begin to look good out in 2012, 13, and 14, and that's when you're going to see the steady gains. And I think probably the same thing is true for the agricultural commodities. You have to keep in mind that on agriculture, the inventory cycles are much shorter than they are in things like energy and minerals, and that tends to make those faster acting on the way up, but also vulnerable on the way down.